Have you ever wondered what investing actually is, or why people say it's one of the best ways to build wealth over time? If words like stocks, bonds, or the stock market sound confusing or intimidating, don't worry. You're not alone. In this guide, we're going to break down investing in simple terms so you can understand what it is, how it works, and how beginners can get started responsibly. First, let's talk about what investing really means. At its core, investing is putting your money into something with the expectation that it will grow over time. Instead of letting your money sit in a bank account where it may barely keep up with inflation, investing gives your money the chance to work for you. You're essentially trading short-term access to your money for the potential of long-term growth. One of the most common ways people invest is through the stock market. When you buy a stock, you're buying a small piece of ownership in a company. If that company grows and becomes more valuable, the value of your shares can increase. Some companies also pay dividends, which are small payments made to shareholders, usually on a regular basis. Stocks can offer high returns over time, but they also come with risk, meaning prices can go up and down, sometimes quickly. Another common investment is bonds. Bonds are basically loans that you give to a government or a company. In return, they pay you interest over a set period of time and then return your original money at the end. Bonds are generally considered safer than stocks, but they usually offer lower returns. Many investors use bonds to balance out the ups and downs of the stock market. You may also hear about mutual funds and exchange-traded funds, or ETFs. These are collections of investments bundled together. Instead of buying individual stocks or bonds, you're buying a small piece of many investments at once. This is called diversification, and it's one of the most important concepts in investing. Diversification helps reduce risk because you're not relying on the success of a single company or investment. Now let's talk about risk, because every investment carries some level of it. Risk simply means uncertainty about returns. Some investments may grow quickly, but can also lose value just as fast. Others grow more slowly, but are more stable. A key rule of investing is that higher potential returns usually come with higher risk. Understanding your own comfort level with risk is an important part of building an investment strategy. Time is another critical factor in investing. One of the biggest advantages investors have is time, especially when they start early. Thanks to compound growth, which is when your earnings start earning their own earnings, even small amounts of money can grow significantly over long periods. This is why many long-term investors focus less on short-term market swings and more on staying invested consistently. For beginners, one of the smartest approaches is to start simple. Many people begin with low-cost index funds or ETFs that track the overall market. These funds spread your money across hundreds or even thousands of companies, helping reduce risk while still allowing for growth. It's also important to invest money you won't need in the near future and to avoid making emotional decisions based on daily market movements. Before you invest, make sure you have a solid financial foundation. This includes having an emergency fund, paying off high-interest debt, and understanding your financial goals. Investing isn't about getting rich overnight. It's about building wealth steadily and patiently over time. In conclusion, investing doesn't have to be complicated or scary. By understanding the basics, managing risk, staying diversified, and thinking long-term, anyone can start investing with confidence. The most important step isn't picking the perfect investment, it's getting started and staying consistent.
Please like and subscribe for more tips.